Welcome back, traders. And in today's lesson, we're going to be going over candlestick basics. This is going to teach you about the candlesticks on the chart. And each one of these is an individual candle. This is called a candlestick chart. So go ahead and make the chart blank so it's easier for you guys to see. So here is the anatomy of a candlestick. So we'll focus on this candlestick for now, this one right here. Okay. So with a bullish candlestick, a candlestick that is going up, this right here is going to indicate the opening price. Let me get a tool out here. Okay. This is where price opens. And then this is where price closes. So you've got your open and you've got your close. And you'll notice that you've got this right above it. And on a lot of these candles, you've got this and this. It's like these long sticks out of it. Well, we call those wicks. And what a wick means is that when price opened here, and this is on the 15-minute time frame, so each candle is equal to the time frame that you're in. So this candle took 15 minutes to form. And in that 15 minutes, price started here, went up and up and up and up and up, and closed here. But before it closed, we had this wick. And what this did, price actually went up here, but then before it closed, it came back down. So this wick basically indicates that price went up here, but it failed to close. And sometimes you can see here, like you've got wicks on both sides. You've got one here and you've got one here. So basically when price got here, it just bounced around and it didn't make any real movement. Okay, so this is the body of the candle that shows the open and the close, and this is the wick, and that shows the price or the range that price went to within that 15 minutes. Okay, so when price got up to here, it shot up, but then it came back down. And it's got a very small body. In this one, price opened here and closed here. Price opened here and closed here. Okay, and for bearish candles, it's just the exact same, except that price opens here. See, on this, you see it on the green one, you see how it opened right here and it closed right here. And on the red, on the bullish candle, it opened there and closed there. Open there, close there. Open there, closed right there. And then this one came down and then went back up before it closed. So that is the basics of a candlestick. You've got your open, your close, your open, your close. The part that's filled in is called the body of the candle, and the part that shoots out from the candle is called the wick. All right, and that's your basics.
The Japanese candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to two simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and one or two tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy.
A hammer is a bullish reversal signal. It has a small real body, very small or no upper shadow, and a long lower shadow. For it to be a proper hammer, the lower shadow needs to be at least twice the size of the real body. As this is a bull signal, we will only look for it in a downtrend. Let's take a look at how hammer forms. Bears were in charge at the start of the session and pushed the price lower. This new low was rejected by bulls who pushed the price back up, creating a long lower shadow. This is how a typical hammer looks. But even a stronger reversal signal is a hammer where bulls manage to push the price above the session's open and close at session's high. A hammer seen after a strong down move at support is a very strong reversal signal and shows us that bulls may be ready to take control. The hanging man looks exactly the same as hammer. The only difference is that we can find it in an uptrend. A lot of trading literature says that the hanging man is a bearish reversal signal, and although it may be true in some cases, I would like you to think a little about what this candlestick really shows you. Remember that the hanging man forms the same way as the hammer. So, after the price has been trending up for a while, bears start to push the price lower, but bulls manage to push the price up closer to its open, creating a long lower shadow. Shooting star is a bearish reversal signal. It has a small real body, very small or no lower shadow, and a long upper shadow. For it to be a proper shooting star, the upper shadow needs to be at least twice the size of the real body. Let's take a look at how shooting star forms. The session started with strong bull pressure. They drove the price up, but the new high was rejected by bears who managed to push the price back down. The reversal signal gets even stronger when bears push the price lower than the open and close at the session's low. The same as for hammer, shooting star has its own double at the other side of the trend. It is called inverted hammer and it can be seen during the downtrend. The inverted hammer is often considered a bullish reversal signal. But once again, I would like you to stop and consider before opening long positions after inverted hammer has appeared. Remember that the long upper shadow means that the initial bullish move was rejected by bears. And when trading reversals, we really want to see a change in the market's psychology. And whatever candlestick signal you see, a long upper shadow is by no means bullish. Tweezer tops is a 2-candlestick bearish reversal pattern. It consists of 2 candlesticks that have approximately same highs. Technically, tweezer tops do not need to have long upper shadows, but the signal works a lot better if it has. Let's take a look at how tweezer tops form. Price is driven up by bulls, but after meeting resistance, bears push the price down towards its opening price. The next session is exactly the same. Bulls manage to drive the price up once more, but the test is unsuccessful as bears take control and push the price back down again and manage to close near or at the session's low. Take a note that candlesticks can be reversed, but the reversal signal will be stronger if the second candlestick is a bearish, like this one. Tweezer tops is a bearish reversal signal, so we will only look for it in an uptrend. On the other side of the trend, we can find the opposite signal, which is called the tweezer bottoms and is a bullish reversal signal. The best thing about tweezer tops and bottoms is that the signal clearly shows a strong support or resistance. Remember that any support or resistance level gets stronger the more times it has been tested. And with this candle signal, you get 2 tests in a row, which makes the support or resistance level even stronger than before. The morning star is a 3-candlestick bullish reversal signal. The first candlestick is a long bearish one. The second candle is a small candle. Perfectly, it will be a doji, representing indecision in the market. And the third one is a long bullish candle that closes above the midpoint of the first candle. As this is a bullish reversal signal, we will only look for it in a downtrend. As you can see, the first candle in this pattern is a bearish continuation. The second candlestick shows that the bearish momentum is slowing down, and only the third candlestick is an actual reversal signal. The signal gets stronger if the third candlestick is a bullish engulfing candle, meaning it closes above the first candlestick's open price. On the other side of the trend, we can find the opposite signal, which is called the evening star. The first candlestick in this signal is a long bullish candle. The second candle is a small candle showing indecision, and the third is a long bearish candle that closes below the midpoint of the first candle. Bullish engulfing pattern is a 2-candlestick bullish reversal signal. The first of the candlesticks is a bearish one. It doesn't need to have a large real body, but the signal is stronger if it has. The second is a long bullish candle that completely wraps around or engulfs the first candlestick's real body. Note that both candlesticks can have small shadows as well. The important thing you have to look at is the real body. This is a really strong reversal signal because not only the second candlestick shows a change in the market player's psychology, but it also has managed to close above the previous candlestick's open. The signal gets stronger if the second candle can wrap around more than one of the previous candles. As this is a bullish reversal signal, we will only look for it in a downtrend. On the other side of the trend, we can see the opposite signal, which is called the bearish engulfing pattern. The first candle in this signal is a bullish candlestick, and the other one is a long bearish one that completely wraps around the first candle. Remember that bullish engulfing signal is only valid in a downtrend, but the bearish engulfing pattern only in an uptrend. 3 white soldiers is a 3-candlestick bullish reversal signal. All 3 candlesticks have large real bodies and have very small or non-existent shadows. The first candlestick is usually a bullish piercing or bullish engulfing candle. The second candle should be bigger than the first, and the third candle should be at least the same size as the second candle. The 3 black crows is a bearish reversal pattern. The same as its bullish counterpart, it consists of 3 long candles with small or no upper shadows. The first candlestick is either a dark cloud cover or a bearish engulfing candlestick. The second candle should be bigger than the first, and the third is at least the same size as the second one. The problem with both of these candlestick signals is that by the time they have fully materialized, the price may have already made the biggest move, so you can't jump in the market straight away. One way to use these signals is to determine when to get out from your existing positions. For example, you have been short here, and after seeing the 3 white soldiers appearing, you close your position to protect your profit. Another way to use them for trading is to wait for the price to retrace and then enter the market with smaller risk. Example here, after 3 black crowds have appeared, you wait for the price to rise again and short the market here. Remember, just like with all the other candlestick signals, these are valid only when seen at support or resistance.